Hello, my YouTube friends, and happy Saturday. Well, the Fed is really kind of screwed here, and not real sure which direction they go. I'll give you my guess and talk about that in this video, and we'll go into how that's going to impact the market. So stick around. Good morning. My name is Adam Kahn, and this is Investing with Adam K. Hope you're all doing well. Today is Saturday, May 11th. Enjoying the day. I got my smoker going. We got friends coming over. I'm cooking some ribs. Kind of enjoy doing that. And as you can see how difficult it is and how hard I have to work while I sit here and do the video. So why do I say the Fed's kind of screwed? What they're running into is unemployment is beginning to spike up a little bit. Inflation isn't really coming down the way that they were hoping. So, higher for longer and a bit stickier. But I think they're going to find themselves in a position that they're going to want to stop the unemployment from going higher. And they may end up having to change the narrative of what they're talking about in terms of the inflation and that 2% target, because it may be harder to get to than they think, and I don't think they're really going to want to crush the economy the way they'll need to. So what ends up happening when they do that? Where do bonds go? What happened to equities? And this is also why I say it's good not why I don't want to listen to the gloom and doomers and try to predict when the right time to buy markets is. Part of why I say that is I think no matter what the Fed ends up doing, equities are likely to go higher. Now, this is not financial advice. Please don't make any decisions in terms of your financial choices on anything I say. I'm just sharing my opinion and the things I see and what works for me. But whether the Fed cuts or raises rates, which I don't really see them raising rates anytime soon. As I said, their goal is not to crush the market. I think they're more likely to be cutting the rates in their next move. I just don't think they're going to be able to cut it as far as they were hoping, because they're going to be tied down by causing the inflation if they cut too far. At the same time, what we're seeing, if the employment begins to pick up, that while I don't think the Fed is pushed by their political beliefs, I do think there are more Democrats than Republicans on the Fed, and their concern about employment and keeping the economy strong and maybe trying to keep the offices the way they are, that their goal will be just not because they're trying to spin anything, just because we all have our natural biases. I'm not that guy. I don't want you to think that I think that, oh, they're trying to push it this way or that way. I just think it's a natural bias that they're not going to want to see the unemployment spike up too far and people be out of work and really see the economy turn into a tailspin, because that could hurt and it would hurt people as well. I don't necessarily see that as a good or a bad thing either. It's just kind of what I see going on. So I picture them getting in a position where they might have to change the narrative a bit of not trying to get to that 2% target and trying to make sure that the economy still holds up, and changing that tone a bit to address the unemployment and keeping people employed and helping the economy to continue along. And don't forget, this is a global economy. So when you see the Swiss cut rates and the UK beginning to imply that they'll probably be able to, as well as Sweden and possibly some other countries, it's hard to imagine we'll continue in a position of holding it too high, making the dollar stronger and stronger. Because some of the countries already, if you look at where the yen is in terms of the dollar and the euro currency, the yen is already getting pushed to the extreme. Their country has already intervened. And when I used to trade on the floor, what I found is eventually intervention worked. It's kind of like the government saying things have gone too far. It generally went against them first, making the traders and the people thinking that it's just going to go on forever, think that the currency is just going to get weaker and weaker and weaker, or that's what's going on now. But if it were going the other way, thinking it's going to get stronger and stronger and stronger. Anyway, generally what I see is the Japanese come in, they start, excuse me, buying up yen to push the prices higher. They stop. the market starts going down and the traders think, see, they're not going to be able to stop it. And then eventually it reverses the other way, and that tends to happen for years. And then the yen may get stronger and stronger and stronger. Again, I'm not telling you this will happen. I'm just telling you that's what used to happen in the past. And as the political tensions are picking up, I think some of the countries are trying to decouple from the dollar a bit. I mean, once we cut off Russia, if you're a country like China, you have to be a little concerned about the relationship and what happens if. Like everything's kind of okay, but meanwhile we're challenging TikTok, we're challenging other things. And if I'm China, maybe I don't want to own so much of my money in dollars, which is what I think is pushing up the gold market. I think that probably continues too. And I'm not a huge gold bug. I'm not saying go buy a bunch of gold. I'm just telling you this is what I think is going on and how I think it's all interrelated. I think you have countries aligning with China. I think you have countries aligning with us. And then I think you have ones in the middle that don't really have an alignment with either. But if I am a country, I do have concerns about how America's behaving in terms of trying to control the financial aspect of what goes on if you get unhappy with something I do. So if I'm a country that's not best friends with America, I don't know how much US dollars I want to hold, and that means treasuries, which puts some selling pressure on the treasury market. Now, all wrapped back around of what this means for our markets and why I'm still bullish equities. I don't know my opinion on bonds. I think that they're more likely, the longer end of the curve, to still sell off, sending yields higher. Because if the Fed has to change the narrative about not pushing to the 2% rate, even if they're able to cut rates a few times to get more in line where the short term rate makes more sense with where the overnight lending is, well, maybe they can't go as far as they were hoping because the inflation will pick up a bit and you'll see the long end of the curve have to make sense with that. And maybe the 10-year even pushes back to 5%. And me and mortgage kind of tells me that maybe rates don't come down the way people were hoping. Neither good nor bad, but me personally, I don't want to really be long CDs or bonds or things like that. They tend to underperform, and if the Fed ends up cutting rates, I see stocks going higher. Me not being able to get the yields that I can currently. As those roll, I'd have to roll into a lower yielding CD or maybe buy equities at that time. And I think if the rates get cut, stocks go higher, the yields I can get in stocks are not going to be as attractive. And now I'm stuck in a position of not making what I am currently. And I'm less worried about today's return than I am tomorrow's. Me personally, I'd rather take the risk, buy a company like Pfizer, get the 6% that I'm getting today, and wherever the stock goes, I think I should be able to rely on the 6% unless something happens with that company. And I don't mean just Pfizer. There are enough companies out there that I'm just using it as one example of things to choose from, because I wouldn't just plow all my money into one thing. I do happen to like Pfizer, but I'm not suggesting that as well, just to be cautious. Um, but that being said, I would rather take the risk of the stock instead of owning a CD where I'm still getting the same return and maybe a little bit more. The only disconnect there is if rates on the 10-year actually go higher, or 2-year or CD or whatever, does Pfizer then go lower from there? I don't think so. I don't think so anyway. Even if rates go higher and bond yield and bond pricing comes down, stocks are generally one of the best hedges against inflation. Why? Because their incomes go up as well. So even if you run into a scenario where rates go higher, the Fed isn't able to cut as much as they think, and so on, I still see equities going higher as well, because that's a sign that the economy is still heated. It's hard to slow it down. And you see prices continue higher, which means earnings go higher. And in the end, the value of the stock is based off of earnings. The part that really just sucks for all of us straightforward, and where the gloom and doomers come from and why they're hyperbole and all the extremists of, oh, the sky is falling, is inflation sucks. We all afford less. Things cost more money. You can't buy as many things. And as it continues, kind of gets worse and worse in some ways. But that doesn't necessarily mean there's any big crash coming. It just means maybe you can't do the things as often as you used to, and you have to be more careful about how you spend your money. What I hate about the doom and gloomers and what I hate about those videos is I think they encourage people not to save. If you sit there talking about the impending collapse or housing prices falling or, the whole world ending because the economy is going to crap, what ends up happening is people don't save and put away. And what I really hope from this channel is I encourage people to save and invest in whatever it is. Again, not financial advice. Don't come looking at me if the markets have a correction, because I'm not making a prediction on any of that. My prediction is you're better off saving and putting away for your future than not. I think the biggest mistake people make in investing is not investing, whether it's concern or fear that they're not going to do well, a lack of understanding, that people in the business talk above their heads, whatever it is that scares people out of the markets. My hope is don't be so scared. Put small amounts in that you're comfortable investing in. Find the things that you know about, that you like, maybe even that you use, and don't worry so much. If you buy Amazon, and I think it closed, I don't know, $180 a share, maybe it was somewhere around $190 a share. I don't have the exact number. And it falls in half. Let's say it falls to below $100 a share. If you put enough money in there that you're comfortable no matter whether it goes higher or lower, it's okay. And if you hold out 10, 20, 30 years, I would guess they're doing better in that time frame. So you don't worry about the short-term moves. The reality is, even though it's difficult and you don't like watching it, in some ways you would rather the prices go lower until the day you retire and need that money, right? I mean, if I'm 30 years old and I buy company X today at dollar Y, if it drops in half, well, hopefully I'm in the position that I can afford more of it and buy more shares. And then by the time I retire, hopefully it's worth a lot more. As you get closer to retirement, that changes, which is also part of the reason I say don't always listen to me. We're all different ages. We have different needs. Whether we're married, how many kids we have, what our timeline for retirement is, all of those things. And on top of it, our risk tolerance. You have to take that all into an account so that you're investing properly for you and not following what I do for what works for me. So while I think the Fed is screwed, and I think all of these macroeconomical things are legitimate, and I think that the wars are a problem, and I think we could see oil prices spike, and all of these scary things going on, they don't stop me from keeping with my plan and continuing to invest. I try to stick with the companies I think are great. I do try to think about it a little bit and make decisions on the companies I put into. I really don't want to be in the ones that I think are super overpriced right now, because if there is a correction, they'll likely correct the most. And generally, that means the names that I don't know much about that I'm buying just because I think they're going higher. And you guys know for yourselves which ones that is. So look at your portfolios, see what makes sense. Dividend stocks, like for where I'm getting in my age, I love dividends. Do I worry that if the Fed isn't able to cut rates the way they hope, that maybe those dividend stocks have to change their dynamics of what the expected yields are in relation to a non-risk asset? Maybe. Does that really change whether I invest in them or not? No, I might take a second look just to make sure I think it's a good company. I do worry about a company like Starbucks that has some rough earnings, and if the economy's slowing down and if things don't really change and they can't cut the rates they hope to offset the borrowing costs, well, maybe they get hurt. But if my timeline is 10 years, do I have a hope that they're able to grow more stores and eventually get some direction to be able to grow business? Yeah, I do. So I try not to worry about it. And I hope you guys don't worry about it too much either. So when you're watching those gloom and doomers talking about the housing crash and the real estate crash, take it with a grain of salt. The same way you should take my videos with a grain of salt too, and not listen to any of us make your own financial decisions. On the more fun side of things, those of you still watching, I'm hoping to take a nice trip to Italy this year. If you have suggestions, please make them in the comment section. Um, I went there maybe 13 years ago, 12 years ago when my son was a baby. We're hoping to spend a few weeks, see the areas. If you know what cities to go to, I had a buddy tell me it's way overcrowded and I shouldn't be going. I was about to look somewhere else to go, and I thought, well, this is where we want to go, and there's so many places that look so interesting. If it's overcrowded, we'll make some adjustments. We'll go somewhere else. Our thought is we'll get on the plane, we'll land, we'll stay wherever we land for a couple of days and maybe go to Rome for a few days and then almost figure it out from there instead of making any concrete plans. So please chime in. Let me know some areas to go if we need to not miss something, or where you guys love, because I love to travel too and I'm excited for the trip. So before I go, before I forget, do me a favor, smash that like button, subscribe if you haven't already, make some comments, not just about Italy. Let me know what you think about the Fed, the markets, what stocks you like, what you don't like. Do you think it's going to crash? Do you think, what do you guys think?